Good afternoon, everyone. In today's video, we're going to focus on the four major indices. So that's the S&P, the Dow, the Nasdaq, and the Russell futures markets. And we're going to try and see how the early morning volatility that we saw may have helped predict the sort of price action we would see as the day progresses. Now, keep in mind, this part of the conversation is just going to be in an observation standpoint. So I'll talk about what actually happened versus some takeaways that might help for the future. Now, starting off with the S&P, we were on our Scalper Volatility Box, and I made a note right here where I expected this volatility to catch up to the Dow, the Nasdaq, and the Russell, given that the Dow and the Nasdaq were both on their aggressive models, and then the Russell was on its conservative model with an active test. Now, to give you an idea of how these rankings play out, we'll come right up here where you can see that the Scalper is our most aggressive model. So if you think about this as stage one, then comes the aggressive volatility box model, which you can argue is the second most aggressive. Then the Doomsday aggressive, which is number three. Then the conservative, which is number four. And then finally the Doomsday conservative models, which we really don't use all that often, but it's there in case we need it. If we break outside of the Doomsday conservative as well, then that's our sign to sit out of that market. Now in today's case, the S&P was still on its scalper, so that's really stage one if you want to think about it that way, versus the Dow and the Nasdaq were in the aggressive volatility box model, meaning we had already broken outside of the scalper. Now, meanwhile, the Russell is on its conservative volatility box with an active test where we were checking to see if we hit 1726 prior to 1716.3. And if we did hit that 1716.3, then that was our sign to switch over to our Doomsday conservative models. So right off the bat here, you should already be able to understand the Russell is the most volatile market that we see so far. Then comes the Dow and the Nasdaq. And then in terms of least volatility, at least as of where we were seeing at 7 a.m. Pacific or 7:25, excuse me, that was the S&P. And so that was where, if you look at this idea of a reversion to the mean, you would expect the S&P to catch up to that of its siblings in the Dow and the Nasdaq. Now let's take a look to see how that actually translated to our charts here. So on the S&P, I have our scalper model plotted. And the actual setup is a breach of our volatility box sign entry line. This is the zone in which we're looking to get either long or short. And then once we breach that line, so price action breaches it, we're looking for an edge signal confirmation. This red arrow if you're looking for a bearish short setup, or a green arrow if you're looking for a long setup. Now, for much of the day here, we didn't really see any breaches, and it looked like it was going to be a fairly muted day in terms of volatility, right? The idea of trying to play this trending move, you had a couple squeeze signals here that gave you some nice bursts up higher, a couple edge signals, but outside of that, no real breaches. Now, the first breach came in that 11 to 12 p.m. Pacific hour. We had price action breach our cyan entry line. So this is the first area in which we're starting to get our attention on the S&P. Once we see that, we're looking for an edge signal confirmation. We got that right here. And after that happens, the trade is a go, where anytime we touch the cyan line in this hour, that trade is valid. So now we touch the cyan line in this next minute candle where price action came down. And at this point right here is where we get filled. Now you'll notice in the case of the S&P, you also have to deal with a good amount of heat, right? It wasn't a clear shot where you just tagged the cyan line and then you reverse from that point. No, you actually had to deal with a substantial amount of volatility. And this is where I think the idea of knowing that the S&P was on the scalper compared to the Dow and the Nasdaq helps to give you an idea of maybe what to expect. Of course, this is 2020 looking back in terms of how much heat you had to deal with here. But say we do get these sorts of hints in the future, which we will. This isn't the first time we've seen something like that. And this could be something that you at least have in the back of your head as a means of trying to scale into your position. In terms of the actual heat you had to deal with on this trade, that was right around 6.45 points. The bare minimum target on this was 7 points, which we ended up hitting not in this move up higher, but in this move up higher right here, right? So once we hit that 7-point target right here, then our stop on that second target is moved from outside of the clouds to break even, giving you a really risk-free trade, looking to see how high we can go and hit that second target line if we do, which is this gray target line right here. Now, given that the S&P fell a little into the clouds, we saw the gray target line also shifted down a bit, where that second target was only 0.5 points more than the first target, so not as typical in terms of a home run sort of trade that we're used to seeing with the second target, but still we ended up hitting the first and second targets. Now, if you contrast this with, say, the NASDAQ, and off of the scalper in the NASDAQ, you'll notice in that first hour, we ended up breaching our cyan entry line, which is the cue that gives us this notion that we should be on the aggressive volatility box, right? It's the fact that we went outside of the clouds, and that's what took us from our scalper to the aggressive. You'll notice via the aggressive, we didn't breach any side cyan entry line. And before the charts change, you'll notice here the scalper also gave you a fairly nice entry here on the NASDAQ futures, but that wasn't one that was valid based off of the model we were on. Now, using the aggressive model, you'll see here no real breaches. Now, if we switch over to the Dow, the interesting thing with the Dow was we did get a wick touch right here, right? But not enough to really get anything filled. But it was a wick touch, which gave you then an edge signal, which then also went off to hit and reverse from the actual cyan entry line. Now, the only trade that actually gave us an entry, though, was the S&P. Now, finally, if I conclude with the Russell here, the Russell, we were on our conservative volatility box, which you'll notice. So off of the aggressive here, we had a likely trending down bubble. This did not end up working the way I thought it would. I expected to see price action go down a bit lower, but that didn't happen. Switching over to the conservative, which is the model that we were on the Russell futures, we didn't have any other breaches for really much of the course of the day here. With the conservative volatility box, we had that open test. We ended up hitting the open test there, so that was the confirmation to continue to use the conservative. But outside of that, we didn't really see any other breach of the cyan line, which gave us an opportunity to get excited. So today, the S&P was the only place where we had a trade that actually set up that met our rules and gave us an opportunity to enter. In terms of clues, we knew the S&P was the least volatile, and the one where we expected the volatility to revert to the mean. The Dow and the Nasdaq were a step higher with the aggressive volatility box, and then finally the Russell was the most volatile, with price action taking us to the conservative volatility box before 7 a.m. Pacific. All right, hope this video helps to give you an idea of not only how to break down volatility, how to take all this information, turn it into clues in a very visual and easy to read format, and then try and use that to actually make some trade decisions. All right, hope this video helps. Take care, everyone. Good luck trading, and we'll see you in the next update.